What's going on, investors? It's AK from Fallible here, and today we are finally gonna talk about gold. All you gold bugs watching, smash like. I know sometimes you're treated like that redheaded stepchild not getting enough attention, but no, not here. Subscribe to this channel because you know we treat you well. And if you're a gold bug, comment down below with a quote from the greatest gold bug of them all, Gold Member. I love gold. All right, I might not get any comments, but I do love this movie. Comment down below with a Gold Member quote and you get bonus points. What those bonus points do is a surprise. You'll just have to comment and find out. But okay, let's go over this gold thesis from our favorite macro analyst, Alex at Macro Ops. So if we look at a chart of gold, we see a nice technical pattern forming here. And more than that, we see volatility for this metal hitting all-time lows. And the way we're measuring volatility here is by the compression of the Bollinger Bands, the monthly ones. So you can see that it's at all-time lows. And the last time this happened was back in 2002, before gold just went on a massive run. And when you get compression and volatility like this, that's usually a signal that a massive move is coming. It's like a coil just being compressed and it's ready to explode. But which direction it's going to explode in, you don't actually know. I mean, this technical pattern is bullish, but how are the fundamentals? Well, that is what we're going to talk about today. So Alex brings up this excerpt from Barton Biggs' Hedgehogging book, which is a great book if you haven't read it. And this is a chapter with a guy named Peter, who Biggs refers to as the most knowledgeable gold analyst in the world. So in analyzing the markets, Peter explained that the stock market explains 88% of the weekly price fluctuations of gold. And there's a reason for this. Only 18% of the gold mined throughout history is held in investment form. That's slightly more than $200 billion worth. But the investable capital markets of the world are estimated to be about 60 trillion. And this is a little old, it's probably bigger than that now. But the point remains the same. There's a lot of money and just a little bit of gold. So in a low return cycle for stocks and bonds, which means you're getting not great returns on either of those, the demand for gold turns positive. But there's always a dramatic shortage of available metal. So this large differential can only be solved by much higher prices, because that's supply and demand, right? If there's a lot of demand, meaning a lot of money, going after a little supply, which is just a little bit of gold, the price of each ounce of that gold is going to shoot up. So the point is that it's not inflation or deflation that's the principal driver of gold, which is what most people think, right? But it's actually a return from other long-term financial assets, particularly equities. And you can see Peter's model right here. When capital markets are doing well, gold is doing horrible. See 10% gain in the capital markets, minus 8% in gold. But look, as the capital markets return keeps going lower and lower, gold keeps going up and up. So at a negative 2% return on capital markets, you're getting a 22% return on gold. They're inversely related. So the two key points to take from Peter is one, that over the long run, and this is what Dalio thinks as well, the price of gold will approximate the total amount of money in circulation divided by the size of the gold stock. There's lots of money, a little bit of gold. And it's not inflation or deflation that's the principal driver, but the return from other long-term financial assets, particularly equities. So if equities suck, gold is going to do better. So okay, let's look at those 2 points. The first, how much money is in the economy? Is the amount of money in circulation set to expand or contract in the coming years? Well, if you've been keeping track of central banks, they are doing nothing but easing. The ECB, the European Central Bank, can't reverse the course that they're on. They're going to keep easing. And the Fed just announced that they're ending their quantitative tightening prematurely. And they're ready to cut rates again because they're willing to let inflation overshoot their target of 2%. And I actually just talked about this in yesterday's video about the yield curve, why the inversion doesn't matter as much because of what the Federal Reserve is doing. If you haven't seen that video, I'm going to link to it up above and in the comments. So that's two big chunks of the world, the EU and then in the United States. And then we have China, who's having their anniversary soon for their glorious Communist Party in 2021. Oh, they're so glorious. So that raises the odds that we're going to see them ease significantly in the second half of this year because they want to pull their economy out of the doldrums and get things running hot just in time for the celebrations. You know, they got a fickle balance over there. Got to keep the people happy or they lose control because they're just running on just mounds and mounds of debt. So everybody's easing. That means more and more money, more liquidity being pumped in the system, more dollars chasing after this small amount of gold. And what's happening is really an event echo of the great financial crisis in 2008. So an event echo is a powerful psychological event like that crypto bust or the great financial crisis, which is what we're talking about, that echoes through time and affects the thinking and actions of the market for years. So the 2008 financial crisis created a collective disaster myopia that is still prevalent today. And this is what, 10 years later. So this is not only noticeable in the psychology of market participants, but also in the policymakers who pull the levers on the economy, the central bankers. As Alex explains, there's a deep-seated fear around experiencing another deflationary liquidity crisis like in 2008. And that fear will continue to drive the impulsive reaction function for creating ever more liquidity. That's bullish for gold. So because people are so scarred by that great financial crisis, they are probably going to overdo the liquidity thing. They're overshooting it because that's just burned into their brains. They want more and more liquidity because the alternative, which is a liquidity crisis, is too difficult to fathom, especially after what already happened. And again, all that money chasing a little bit of gold, that is good for gold. But there's another point, right? It's not just liquidity or how much money there is, but the price of gold is also determined by the expected returns for other asset classes. So here is a 7-year forecast of asset returns. And as you can see, US large caps have a predicted return of negative 3.7%. And these stocks make up the majority of global equities. So that is not good. And again, what happens when you have negative returns in capital markets? You get some good returns in gold because people are flooding over there. So we have the two necessary ingredients for a major bull market in gold. The first is low expected returns for long-term financial assets, and the second is a global money stock that's likely to keep growing, potentially a lot, because they just want to ease more and more. So when you combine this with the textbook long-term inverted head and shoulders bottom pattern forming, which is right here, this head and shoulders, so a long-term pattern all the way from 2013 until now, a breakout from here is a clear trading opportunity. So gold bugs, it is time to get excited. We're with you on this one. Smoking a pancake? But okay, if you want to keep tracking stuff like gold, then make sure you subscribe to this channel and hit that notification bell so you get an email notification when our future videos come out. We publish every single day, 7 days a week on all sorts of topics, business and market related. But yes, subscribe. Foxy Cleopatra would want you to. I will see you in the next video. Stay fallible out there. Bye.